A lot to unpack on this week's episode. We got Stats Canada releasing its CPI numbers for the month of October. How is that going to impact the Bank of Canada? What are our thoughts? And more importantly, what came out of the economic budget released and tabled by Chrystia Freeland, our Minister of Finance for the Liberal government. Obviously, a lot of conversations happening with the current state of housing, where a lot of this money is going to be spent. And more importantly, what is the Bank of Canada's next rate decision going to look like? So welcome back to the channel. It's Friday, Finance Fridays, and I'm your host, Anthony, with InTouch Mortgage Solutions. And if you're new to the channel, we invite you to subscribe. And don't forget to hit that notification bell so you can get notified every time we post a new video. So let's dive into these CPI numbers and what it could mean for the Bank of Canada. First and foremost, the data for October came in at 3.1%, slightly lower than the 3.8% for the month of September. A lot of that has to do with the price of fuel coming down, obviously moving the needle in the proper direction, but we're still elevated. A lot of that inflation is coming from higher rents and higher mortgage costs at around 30.5%. But the headline inflation is not the whole story. We're looking at those core numbers that strip away things like food and energy, and those 3-month rolling averages are starting to come down, and we're seeing medium and trim inflation come down as well. So these are definitely things pointing in the right direction, especially if the Bank of Canada is looking at that data ahead of their next rate decision coming up in December. It is pretty much almost baked into the cake that the Bank of Canada is going to have to pause in December based on these lower inflation numbers as they sit back and continuously monitor the existing situation with the economy, talking about the economy. Why? Well, obviously inflation's coming down. That means monetary policy is working. Those higher rates are really playing into Canadians' spending, into the household budgets, and obviously in the actual market right now, what's happening with service sector, what's happening with manufacturing, what's happening with businesses. As unemployment ticks up, we have the immigration story here in Canada, which deviates us from the US. We have more people arriving, which obviously, as you know, we need more people to replace the aging population and contribute to increased taxation, obviously generating revenue for our government that seems to have a big spending problem. And we'll talk about that and more in just a moment. So obviously we look at all these things together. We see that Canada's slowly entering that recession. I think we already are in a recession. If we think about negative growth, we think about contraction in spending and growth, especially when we think about higher immigration levels. These two things generally mean that when you have higher immigration, more people, well, you definitely have higher spending. So the Bank of Canada is noticing this, and to mention the elephant in the room, so to speak, is these mortgage renewals, these mortgage renewal cliff that's fast approaching. Many Canadians already in 2023 have renewed into higher mortgages, and there's more pain to come for a lot of Canadians unless we see some relief in these interest rates. Now, the Bank of Canada obviously potentially could pause, but that only impacts Canadians with variable rate mortgages. And as you may recall, a large chunk of Canadians took on a variable rate mortgage, whether it be adjustable or static with a trigger rate, back when interest rates were much lower, and obviously looking at their particular financial situation, and something that was brought in to the forefront with the mortgage charter, this new charter that's sort of being launched by the Liberal government right now. And obviously in the protection mode, we'll talk a little bit more about how all these things are playing in, because one of the major components of this mortgage charter that I found really interesting, amongst other things, was the renewal for Canadians with insured mortgages. So if you have a mortgage and you're approaching renewal, generally what happens is you need to either renew with the existing lender, or if you're looking to switch or transfer to another lender, you have to undergo the stress test and the current qualification, so the contract rate plus 2%. There were certain exemptions if you had a mortgage that was issued prior to 2018 or 2017, where you were able to basically undergo renewal, switch, transfer without having to go bypass the stress test. But now all those mortgages have pretty much almost passed through the system. Now it's insured mortgages that are allowed to basically switch or transfer to a different lender without having to undergo the stress test rule. Now, wait a minute. The important part is that you cannot refinance. You cannot ask for new money. You have to take your existing balance from lender A and switch it to lender B, not having to undergo the stress test. I believe this is really good as long as you're not asking for new money. Why? Because you're just taking the existing balance, and rather than having it tied to one particular lender that may or may not be aware that you or cannot switch over, you're subject to only the rates that they have to offer, especially if you don't qualify to switch. But if you can, well, then you have the options to move lenders. And by doing this, I believe they open up a little bit more opportunity to allow Canadians to shop around for their existing mortgage. Now, there's a whole bunch of things. Like, this was something that was already in the fine print with some of these B20 guidelines. So I believe the government's done a really good job at, sort of repackaging some of this stuff and obviously bringing it to the forefront. By that, I mean what we talked about several months ago with the Federal Consumer Agency of Canada, talking to individuals that are under distress, individuals that are finding it challenging to make their mortgage payments. So what things should happen by the banks, or by the banks helping their clients, because now the government's stepping in. But a lot of the banks were actually helping Canadians with extending their amortizations. Now, obviously not beyond the OSFI regulations, right? So we're talking about Canadians that maybe had a mortgage that started many years ago. Now they've gone from 25 to 10 years, and now they're finding financially difficult to make ends meet. They can maybe go to their lender. Lender will re-amortize them back up to 25 or 30 years, depending on their situation. But obviously for Canadians that are finding themselves in these negative amortizations based on variable rate mortgages, well, OSFI is trying to push these lenders to make amendments. And obviously now we have to look at how this could impact Canadians. So maybe there's a lot of situations that could pop up where Canadians may need to put their homes up for sale. So there's the conversation around prepayments, prepayment privileges. So if you have a mortgage in Canada, and let's say you want to put some extra money towards your mortgage each and every year, you have to refer to your contract. Maybe you can only put 10, 15, or 20% down. If you put more than what is allowed, you will be charged a penalty to put money towards your mortgage. And obviously this is something that the Liberal government wants to pay close attention to, because let's say you're in a negative amortization, you have some money and you want to pay down your mortgage to bring that amortization back into line. Why should you get penalized with a penalty to do that if you are looking to bring your mortgage back in alignment? And then the other side of that is if you're in a position where you have to sell your home because of some unforeseen circumstances and you're in distress and you break your mortgage early, well, if you can prove that you're in distress, then you shouldn't be charged a penalty to do so. And I do agree with that. And, sometimes banks are willing and inclined to help, especially depending on the circumstance. But when it comes to penalties, I think this is something that's really interesting. But when it comes to the fees and it comes to interest on interest, this is something that may or may not be new for some lenders. Obviously, you have to look at everything with a eyes wide open, because all this administration that the government's putting forward now has to be advocated for by the banks and their legal teams. So it's not just going to happen overnight. It could take some time to see these things roll out, much like the first home savers account when it was launched. It took banks some time to actually make these things work. So we're going to keep everyone up to date with what's happening with this mortgage charter, how this can impact Canadians. But there are some good and some, questionable things in there. I think there's a lot more that could have been done to help Canadians in particular situations. And the reason why we say that, and obviously it's always buyer beware or consumer beware, because a lot of individuals we talked to had no idea what they were sold, what their bank had told them until the time came when they needed to exit or they can't exit. So always talking to a mortgage professional, getting that second opinion can help keep thousands of dollars in your pocket. Just because you could, I should say, doesn't mean you should. And we talk about home prices. We have a lot of clients that are buying, looking to go out there and make a purchase in this market. And although they're qualified for a larger amount, they're scaling back. And that's usually something that's smart to do. And obviously, looking at the whole picture, right? We're looking at what's happening in the economy right now. We're looking at the housing market. We're looking at affordability. These are major concerns, these renewals, right? So if we look at the budget, what's coming out, if the government's running a $40 billion deficit, they're trying to focus in on building more rental supply. They're looking to get builders out there building purpose-built rentals. They're removing the GST. They're extending money into these accelerator funds. They're meeting these guidelines. And although on the surface, this is fantastic, right? This is great. This is exactly what we need. A little too late. I mean, our current administration has been in power for some time, since 2015. They've had a good runway to start to address these issues. And I feel personally that now all these budget expenditures are going to happen in 2025. And 2025 aligns with the next election. It may come sooner, but that's when the next election is set to take place in the year 2025. And all this expenditure is maybe a ploy to win votes, maybe to regain confidence in the current administration, the incumbent government, as it faces severe criticism from its opposition leaders, right? Not only from the Conservatives, but other members as well. And this is the major question right now. Is the idea to tackle the housing affordability and housing crisis a little bit too late? Can they actually win this battle? And could even a new government that comes into play, let's say in 2025, solve the problem that's taken decades to create? And this is something that I always question, saying, look, we have a current situation right now. We have a government that is spending out of control. Yes, they're now starting to spend money in better, better areas, especially housing. But it always begs the question you have to ask is, the government now is going to look at removing some of their federal buildings and repurposing them into rentals. And, is it the government that's going to be responsible? They're going to have a consulting company hired to do this particular work, because we look at the Arrive Can app, and I'm not trying to get political here, but I look at the expenditure and we talk to people and we say, look, you built this app, it cost like $52 million. Could it have not been done cheaper, especially that it's tax dollars that we've contributed to build this app out? And now we're going to say to the government officials that are going to say, hey, we're converting these government buildings. Is it a private sector thing? Is it a public sector thing to get these contracts built out? And it's like an insurance situation. I always use this example. If you're someone who's self-employed and doesn't have insurance and you walk into the dentist, you might say, look, I don't have coverage. It's one price. If you do have coverage and it's going to be billed through the insurance company, it's another price, like a tow truck. If you go through the insurance, it's one price. If you're paying cash or paying out of pocket, it's a different price. And if it's somebody doing work for the government, is it one price versus someone who's going to do it and say, hey, leave it to the private sector? So just wanted to throw those thoughts out, especially when we look at the budget. And the final point is I'm glad to see that in part of this conversation, at least we're starting to tackle not only the housing front. Yes, we need more purpose-built rentals. We need these particular elements to come to the market, but we also need the people to build them. And one interesting point was that they're now focusing in on those skilled trades. They're going to be bringing in people that have the criteria to help build, because we have an aging population of the skilled labor force, and they're all within 15 to 20 years of retirement. And who's going to come in and replace them and build all these millions of homes that we so desperately need in this country? So obviously, we'll see exactly how things play out. We'll be talking more about the Bank of Canada in our future episodes. So make sure you're subscribed to the channel and let us know your thoughts in the comment sections below. Is the government going to have the runway to actually solve these housing problems with more money, or is it a little bit too late? Is it going to be the responsibility of the next government? And what do you think? Because of the fact that they're approaching 2025, all this money is going to be spent closer to the maybe the election time when many Canadians are going to be voting or going to the polls. Is that a ploy just to buy some votes? Let us know what you think in the comment sections below, but we'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for clicking.